Welcome back to another episode of Gimme Some Truth. We have Clint and Mitch in the booth with myself today. We are talking about non-qualified deferred compensation. It's a mouthful, we realize, but if it is something that applies to you, it can be very, very powerful and something you should definitely think about. This is kind of Mitch's topic. Mitch runs a team with Alicia here in the firm, and they specialize in executive compensation and stock options, that kind of thing. And so this is kind of right up his alley. Mitch, why do you like this topic? What is it that kind of intrigues you about it?
I like it because there's a lot of unique planning opportunities.
Okay.
And it's also not available to everyone. A lot of people in Madison hear Wisconsin deferred compensation, which a lot of people connected to the university, UW Health, et cetera, they might have access to that. That's a different topic, not to be confused with non-qualified deferred comp. So I'd say unique planning opportunities, number one, is why it's interest. And then there's just some kind of cool things when it comes to planning and taxes and the use case for it. So I think it's an exciting topic.
I was shocked when I did some research before the podcast on it, the number of companies that offer it. I was really surprised. I'm not going to quote a stat because I don't know if it was accurate in what I saw.
Dang it, I wanted you to, because Clint asked me that question this morning and I said, you know what? I don't know.
I want to say that the stat I saw was maybe around 80% of companies, which seems crazy high.
Of public companies.
Yes, that probably is the determining factor. But
I think it is a public company phenomenon. It seems like a lot of people that have, kind of that 401k at Fidelity, I see a lot of that where I see some non-qualified deferred comp and kind of attached to that.
Private companies can have it too.
Yeah.
There's no limitation from that perspective, but once you start talking to these bigger companies with lots of employees, sometimes, all over the country, when it comes to the executive management, director level, highly paid, that's another one of those carrots that they have when it comes to attracting talent.
So I guess the first kind of recommendation, if you will, would be if you have graduated to that point in your career, you need to start asking about this option because it might not be abundantly clear that it's available, one. And two, it's not something that's often talked about. And so I think it can be maybe missed if you have kind of graduated to that director level, executive level within your company.
Yeah, and we work with people that have actually gone through that progression since working together. So let's say they're just in a role at a company, right? And then they get promoted a couple times. Next thing you know, they're director level. And a lot of times how this happens, I just get an email forwarded to me in the fall sometimes for the next season that said, hey, what is this? Like, Mitch, can you tell me about this? It sounds too good to be true sometimes is what people say, because a lot of times it's advertised internally within the company as, hey, this is something where you can put more money in above and beyond your 401k limits. And I think people are so ingrained that, I only have $24,500 that I can put into my 401k and that's it. Well, no, enter the non-qualified deferred comp plan. And that's a place where they can still put more money in, tax deferred, because presumably some of these people are at a higher tax bracket, if they're management, director level and above. So it's a pretty attractive story from a tax perspective, but then there are risks, and we'll get into that, and trade-offs certainly compared to how flexible they are compared to your 401k and things like that. But
can you? I think that too. If you could take a moment to kind of define that terminology there, because I think non-qualified gives people, they don't know exactly what that means. So can you define for the audience kind of what non-qualified means in this context?
Yeah, I'm going to simplify a little bit here, but for qualified, think 401k. You got your 401k at your employer, you're putting money into that, tax deferred, maybe you're doing Roth, that sort of thing. But then non-qualified, it's not subject to the limits, basically. So it's this whole other carve out that companies have a little bit more control on how they offer it, but there's not really a limit on how much you can put into this thing, as long as the employee's salary is considered reasonable, which is kind of a gray area, which I'm not going to get into, but it has to be a reasonable salary, reasonable compensation for the level of work that they're doing.
So very flexible on the contribution amount, however, very, very restrictive in the other characteristics of the plan.
Yes. So once you make an election, and when I say election, let's compare 401k, for example here. 401k, any pay period, I can go in and say, I want to reduce my contribution, or I want to change it from pre-tax to Roth, or I want to change my investment options. I could do that today after this podcast if I wanted to. Not the case with a non-qualified deferred comp. So you enroll. A lot of times in the fall, they'll say, hey, our enrollment period is, the month of November, let's say. And it's for the following tax year.
Because it has to be declared for the previous year for the next year.
Yep. So we're recording here in 26, in the spring of 26. Let's say fall of 26, these employees get this email. It says, you're eligible for non-qualified deferred comp. It is above and beyond your 401k. How much do you want to put in it, basically? And sometimes it can be up to 75% of your salary.
Sure.
So you can defer a significant portion of your income into this thing, and sometimes bonus too. Can be bonus, could be salary. And when you make that election, when that enrollment period ends, let's just say December 1st, the company says that's when your enrollment ends, then you're basically stuck. Now, what do you have to choose when you enroll? You enroll how much? Say 25% of my salary. Great. 25% of my bonus. Great. Like the name implies, it's deferred comp. So there's no pre-tax versus Roth. This is all tax deferred. And then you need to choose when you want the income. That's another very, very different thing. 401k, you retire, you're 62, let's say, you roll it over. You can do whatever you want with it, right? You can cash out the whole thing. You can turn on monthly. Non-qualified deferred comp, you choose that when you elect. And after that, very inflexible, to your point, Nate, to bring it around. Can be flexible on how the company designs it. Very, very, very inflexible once you make those enrollments. Hey, I'm deferring till 2035. And that's basically it.
How do you see use cases, Clint? How do you see people potentially using this? I saw some things online, maybe big purchases, funding kids' college. I mean, how do you see it used more often than not?
Yeah, I mean, that's that. And that's, if you get those big splash years where you get this big, you know that it's impending. And I know Mitch has an example on a local company in Exact Sciences for us that just got bought out. But if income's spiking, we want to delay income as much as possible. So, it could be that, you're getting a big award that year, an acquisition, and I do think that, and if you just know that your income is spiking or you're in the twilight of your career, that could be another thing too, where that the inevitability of you ratcheting work down or leaving the workforce is coming soon. That's a time to sock away. If you're earning $750, $800 million a year, and we know that 5 years from now, you're in retirement, you'll be earning maybe Social Security income or maybe not even that. Great time to delay income out of those high tax brackets and push those back down to lower brackets. So, the inflexibility there is your friend. I think for young people, it's a bit of a challenge because we don't know for a lot of those people where their income's going to be, and them getting into a non-qualified deferred compensation early may not help them at all. They could end up in a much higher tax bracket over time. So you've got to meet with your financial advisor and go through, the use case there and make sure that you're not just signing up for something because it sounds all right and my income's high today, but your income could be way higher tomorrow. So you've got to be careful, tread lightly on that and not overextend yourself.
Not necessarily designed for people, to your point, in the last few years of their careers, but probably nudges that way more than somebody that has 20 years left in their career, I would assume.
I would bet the demographics are, well above 50 for the heavy utilizers of this, for sure.
Yeah.
Yeah.
And this is a great point to talk about one of the very key risks. So 401k, those assets are yours, right? You put it in, and your employer puts money into typically. That might be subject to a vesting schedule. But what you put in is going to be yours, subject to market volatility. With a non-qualified deferred comp plan, it's actually on the company's books. It's subject to creditors. So it's a future promise to pay. So in the case what we're talking about, young versus, older in their career, right? If someone says, well, right now the financial stability of my company, I believe that 5 years from now, in my hypothetical deferment, I believe they'll still have capacity to pay 5 years from now. That 30-something-year-old that's looking 20, 30 years time horizon, I don't know. I mean, the longer you defer, the more risk there is because you are counting on the company to still have the ability to pay you.
Yeah, let's unpack that just a minute. So 401ks are required to have third-party administrators and kind of separate companies involved administering the plan, whether it be, Guideline or Fidelity or whoever it might be, right? So that money is with a separate company so that if the main company fails, your 401k is already funded and protected and moved somewhere else. That is not the case here.
That is not the case here.
Money, your future money is still with the company that you are with and therefore are subject to the sustainability of that company.
Yes. And that steers the decision for some people, especially I'll say the ones that are earlier on in their career. They might say, you know what, I want control. I want my money. I don't care if I'm at the 32% tax bracket or above. I'd rather have that and then just invest in a brokerage account.
Sure.
And that's just fine. Because this is a yearly enrollment too. That's the other thing. 401k, right? You can change that election anytime. We already talked about that. This is annually. So you elect it once. Okay, great. Now 2027 comes here. You might have another enrollment window. 2028 comes, another enrollment window. So you elect every single year that it becomes available to you. So that's a consideration too. Just because you pass on it one year doesn't mean the next year you might. And I had so many Exact Sciences employees that said, you know what, I'm not going to participate. All of a sudden, Abbott announces acquisition. Ooh, 2026 will be a spicy tax year. I am absolutely going to participate. And they might not participate in it again.
Yeah. The money's invested, yes?
Yep. You typically have similar investment options as your 401k. And then they just credit you basically the investment performance to your future payout.
Yeah. The only other point that I want to clarify too is that you've referenced a few times, you get in the fall, you get the email from the company, That's not required. So your company doesn't have to send you that email necessarily. So
if you're eligible, so like not everyone is going to be eligible.
Sure.
Right. But if you're eligible, you'll get that communication.
Yeah. So I think that's the clarification too, is just, it's a little bit of kind of own it yourself and not rely on the company. You kind of get that clarification if you might be within that, in the parameters of that plan.
And one downfall I've seen from company communications is it's so isolated to that employee, right? They're like, oh, so if your wages are X amount of dollars, this might make sense. Great. Okay. What if your spouse earns 3 times as much as you do? What if your spouse doesn't work? Like there's so many different factors. So when it comes to married couples that are planning jointly, that have a joint tax return, there's gonna be other factors. Maybe maybe your spouse is gonna sell their company stock, or they had some big bonus or something paid out. There's so many things that are gonna fit together. It's definitely not just one size fits all.
Yeah, you got to look at your tax return. You got to look at those.
Yes.
The RSU problem, where all these people out there, we see it all the time, have restricted stock units, and it shows up on their taxable income, and they don't even think they have it. Right. And all of a sudden, their taxable income is really, really high, and they have to plan around that, and that might be a reason to do non-qualified deferred compensation. So what happens then, Mitch, if somebody leaves their company and now they've got a bunch of non-deferred compensation?
Yeah, so they can leave the company, and typically it's whatever you elect is, and this also depends on the age. There's lots, it depends here, but when you pick that age or year that it pays out, that's when it's going to pay out. But there's a lot of times there's provision for death, disability, things like that, and a lot of those cases it'll be paid out in lump sum, typically to your beneficiary. So you still put a beneficiary on it, whether it's a spouse or somebody else. So there's different situations there for sure. I'd say it's going to depend on how the plan is designed.
I think that ultimately, and it's so funny, we sound like broken record when we do these podcasts, but so much of this comes back to the idea of what planning, right? I mean, and it's just so important. Can you just touch on that as we close here? Obviously, you need to have your accountant involved, potentially even like your estate planning attorney involved, your financial advisor. I mean, it needs to be a concert of voices that make this educated decision.
Yeah, I think that people will just sometimes take their open enrollment and benefits and they just kind of cast it aside, and then we get an email like 1 second before enrollment, and a lot of times we're like, okay, and we have to zoom out, and sometimes we have to do it quickly, and it's a lot better to get this information when they get it with the ample amount of time to analyze it if we need to. Because there's, like you said, you're exactly right, a lot of nuance to it, and we want to make a good decision here. And sometimes we have time frames that get compressed, like Exact Sciences that kind of came out of nowhere, where we had this announcement, and now we have to plan for it in seemingly the last few weeks of the year.
That's exactly what happened.
Yeah, so sometimes you just have to do it and just kind of jump in the pond. But it's good to have some time, and build that plan around there and have a strategy in place for sure.
I think this one is better too because, Mitch, as you alluded to, this tends to be kind of a fall idea or concept. So now's a great time to check with your benefits office if you did get a promotion, if your income did go up drastically, if you know you have a big bonus coming, check with the benefits office. Hey, do we have this? Would I qualify for this? Just kind of lead into that so that you give us and your financial advisors, your estate planning attorney, your accountant, everybody enough time to be able to plan for this. It's a huge decision. I think that's come through very clearly this morning. So that's something that you definitely want to have enough time so that you can think about it and make sure that this is the right decision for you. I'll close on a happy note. This is one of the last 3 or 4, depending, podcasts that we will film this morning in this room. We have bought a new building. We are moving the podcast operations there. It's a little bit of a kind of a bittersweet day. I like this room. I like the design. I like the feel of it. But we're being told by the powers that be, 2 of which are just off camera to my left, that the next iteration will be even better.
They said way better.
Way better.
Yeah.
Is that?
Are we getting new hosts? Is that the?
I think so. I'm
kidding.
I'm gonna get frosted
Addition by
tips.
subtraction.
Yeah, I'm getting some frosted tips, and it's gonna be way better as a result.
People will be the same. Let's make that very clear.
Yes, the backdrop will be different, but yes, the voices will be the same, fortunately or unfortunately. So thank you again for tuning in to another episode of Gimme Some Truth.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.